I'm Pierre, Daillie, managing editor of advisoranalyst.com. My co-host is Mike Philbrick, CEO of Resolve Asset Management, SEZC. Our guests today are Dave Nadig, Chief Investment Officer at ETF Database and ETF Trends, and Tim Nash of Good Investing. This is episode 2 of Raise Your Average.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
So welcome, everyone. Welcome, Dave Nadig. Welcome, Tim Nash. It's really awesome to have you guys on. The plan for today's discussion is to dig into all things in the realm of ESG investing. You guys are both tremendous authorities on this subject. And I think maybe the best way to kick it off, Dave, you're the CIO at ETF Database and ETF Trends. Why don't you tell us, for the benefit of those who are listening, watching, a little bit about your background and what you're up to these days.
So background-wise, I started in the ETF business back in 1992. Before there were ETFs, I was at Barclays Global Investors back then and watched the launch of SPY in 93 and then worked on the team that launched in 94, 95, what became the World Equity Benchmark shares, which then eventually, after many mergers and acquisitions and growth plans and rebrandings, became iShares, which folks know today. And most of those country funds are still trading as iShares country funds. But along the way, I've been an active mutual fund manager. I was really terrible at that. Nobody should hire me to figure out what tech stocks to buy. And then came over to join ETF.com sort of around 2009, and then was there for a period of time, built a data business, eventually became the CEO of ETF.com, and then moved over in January this year, I guess still, to ETF Trends and ETF Database to sort of build out the offering there. So that's sort of my basic background.
That's great. How about you, Tim?
So I grew up with my dad in the investment industry. So I kind of grew up in stocks and bonds and always had a good head for it. I studied economics and philosophy in my undergrad. So I was kind of the weirdo in each of those faculties. And really, I would say that as I was studying our economic models, really my spidey sense was tingling. It just felt like there was something off. I did a little bit of travel. I did an exchange to New Zealand where I learned about triple bottom line economics for the first time, this idea of people, planet, profit, and light bulbs just went off in my head, that this was really the gap in the marketplace, that economic models were just dismissing social and environmental issues as quote unquote externalities. Went back to my fourth year economics department full of questions, and they didn't have answers for me. So I graduated with my BA in economics, and then I went to Sweden where I did my master's in sustainability. And this was back in 2007, 2008, when before, sustainability really was sort of the buzzword that it is today. But that's where I learned systems thinking, and I learned engineering for a sustainable society, all these different green technologies. And I did my thesis looking at socially responsible investment. And right away, what we found right off the bat is that everybody automatically assumed lower financial returns. Like right off the bat, that was the sort of, automatic assumption. So we did our thesis looking at the financial materiality of ESG risks, and really looking at this through a lens, not only of sort of a risk assessment, but also really through this lens of financial materiality. And what we found is that really there's no need to sacrifice returns. And in fact, I would argue that, with macro trends going the way they are, that there is opportunity to identify mispriced assets and actually get ahead of some of these curves here. So for me, it really exciting. Graduated in July of 2008,
great timing.
Ready to take the investment world by storm. Right? Just couldn't have timed it better. And at that point, with that crash, sustainability really got thrown on the back burner. Like, it was really like, let's fix the economy and then we'll worry about these social environmental issues. So no one was willing to give me a job working in this field. So I created my own. And, I've been at it for about 10 or 12 years, tried a few different business models that didn't succeed as well. Taught economics for a little while at my local community college. And then probably about 4 years ago, really jumped into this idea of fee for service financial planning. So I spend my days helping regular people, I'm super retail focused. I charge on a sliding scale to try to make it affordable and accessible. And what I do is I teach people how to invest their own money online according to their values. What this means is that I'm really up to speed in terms of all the different ESG ETFs that are out there, and really understanding, how you can fit them together in a portfolio really across a broad range of spectrums or sort of definitions of sustainability.
Excellent.
That's fantastic. Yeah.
Excellent.
So I think those insights are going to be, particularly useful today as we delve into the alphabet soup of SRI, ESG, and ABC. And help both advisors and allocators identify with the end client or board, understand what they want, how can they incorporate this, how can they educate and teach and sort of pass on the knowledge so that these investors can make the smart decisions, the right decisions, the decisions that are in alignment with the values that they're trying to express. And it seems it certainly has been a ripper of a year in growth in this space. And maybe I'll throw it over to you, Dave, to just give us a sense of what the flows have been like in this particular area for a number of reasons. And please, by all means, speculate as much as you want on why you think we've seen
Sure.
these
with the
flows
giant caveat that this is really coming from an American lens. That's the market I tend to spend almost all of my time covering, as much as I have a love affair with the Canadian ETF market, because the OSC tends to be the forebearer of everything interesting that happens in the US. But in this case, I think the ETF's leading on the flows side a little bit. Just to put some context in it, if you look at all ETFs and mutual funds in the US and you go back 10 years, we had about 120, 115 billion in all in ESG related packaged products. Now, of course, there was a lot more money invested along ESG guidelines, but that was in separate accounts, institutional funds, et cetera. So leaving that aside, we've gone from that 120 about 10 years ago to about 1.6 trillion now in the US in identifiable packaged products. And historically, most of that money has gone into mutual funds, a lot of it through 401k or defined contribution plans here in the US. But this year in particular, and really going back to sort of mid-2019, has been the growth hockey stick curve for ETFs in the space. So we went into the beginning of 2020 with about $25-30 billion in assets. We're going to leave this year with about 65. Most of that's organic flow. So about 35-37 billion in organic flow into the ETF space. And that really kicked in at the beginning of last year. So if you look at a chart of AUM growth, you'll see absolutely nothing, and then sort of a kick up in 19, and then Katie bar the door for 2020. And I think there are a couple of reasons for it. They're obviously big long-term drivers of ESG adoption. A big one is the transfer of wealth from the baby boom generation down into maybe younger Gen Xers, older millennials. And that's something we do hear from advisors almost weekly when we talk to them about, ESG and whether it's something they're interested in. A lot of older advisors in the US aren't actually all that interested, but their clients are making them interested whether they want to be or not. So most big advisory firms in the US, whether they're wirehouse and sort of traditional broker oriented or whether they're independents, now have some sort of ESG sleeve, whether it's a key part of their practice or whether it's just sort of an also ran and they've just sort of done the minimum they can to get through a meeting when somebody brings up ESG. So that, I think there is that pressure, but I think it's also worth pointing out that, to Tim's point earlier about that belief that you have to sacrifice returns, I think March and April did a pretty good job of putting a nail in that coffin, because what you found is many, not all, but many ESG products kept their clients out of trouble in March and April. Some of that was just underweighting energy, fine. But a lot of it was actually really longer term stuff, right? A lot of the stuff we saw about this K-shaped recovery, where certain winners and certain losers were really obvious to everybody. A lot of those winners are companies that, whether it's causal or not, doesn't really matter, happen to score really well in most ESG methodologies.
Love that. Now, so we talked a little bit, or I mentioned a little bit, the alphabet soup of ESG. I wonder, Tim, if I could throw it over you to kind of cover the continuum of, values-based versus ESG integration versus impact investing, and maybe sort of give everybody some insight into what these columns or these different areas mean, so that they can sort of identify from a values basis of how they might want to integrate some or all of these.
Yeah, so the lack of a common taxonomy is something that has really hurt, I think, the sort of growth and development in this space. That it's very tricky to communicate, before any of this stuff, and then you throw in a lot of language and with overlap and miscommunication, and it becomes challenging pretty quick. So let me kind of try to map it out. I'll do my best here. It's not perfect. I know that this is my approach. That I think everyone kind of has their own spin, but obviously I've been doing this for a little while. So really, for me, the umbrella term is this idea of sustainable investing. That to me is sort of the broadest, just like kind of the biggest there. From there, I would say you have the different approaches. The language that I use is that I break it up between what I call doing less evil versus doing more good. And to me, these are very, very different approaches that often get lumped together. And I think it's really problematic for benchmarking, really for everything, that I kind of like to keep them a little bit aside. The doing less evil piece, this would have had its foundations in ethical investing, where you often have what are called like negative screens, where we want to get rid of the sin stocks of sort of alcohol, tobacco, weapons, etc. Now, I would say the biggest piece of that is fossil fuel divestment. That is just, really, I think, eclipsed in terms of demand. I know a lot of people that are fine owning, alcohol companies, right? But it's like they'll be damned if they're going to own, one share of a fossil fuel extractive company. From there, also in that doing less evil, you have this notion of ESG integration. So this is where, environmental, social, governance analysis. To me, ESG is sort of like a code word for sustainability analysis, where companies are now reporting on this ESG data. Investors are then taking that data, doing scoring, doing different comparing versus benchmarks. Again, this piece is tricky because there is no consensus around ESG and what this means. So the two largest firms are MSCI and Sustainalytics. And Sustainalytics just got bought by Morningstar. So really it's MSCI and Morningstar. And that they use very different approaches. And I'll often look up a company that scores very differently on both of them. So, it's not something I want to say is like a broad base, like there's one definitive ESG score. This is something that's evolving. This is something that's changing, where there is some nuance there. Personally, I like the diversification that, I know sort of what to go to a Morningstar for and what to go to MSCI for, but I understand that can be a little bit tricky for advisors, and really, I think you almost have to pick one and sort of roll with that, unless you're willing to play in the weeds a little bit. And then from there, also in this doing less evil approach is this notion of shareholder engagement. So this is the idea that, there might be some companies in here that I don't love. I kind of need to hold my nose and invest in these because, it might not be perfect, but at least the fund companies are engaging with the companies, pushing them in a more sustainable direction, using proxy voting guidelines to ensure that the investors who care about these issues are voting for measures that encourage things like, diversity in senior management, the board of directors, stay on pay, executive compensation, reporting around, worker safety and emissions, things like that. So, really that's an area where, again, there's a wide spectrum. From there, I would sort of shift over to what I call the doing more good, where most of this, certainly in the ETF space, would be around what we would call thematic investments. These are going to be investment things like clean tech, renewable energy, water infrastructure. There's an ETF linked to the Sustainable Development Goals. There's, a whole bunch of these different sort of thematics. These are all completely different with very different risk return profiles. Each one is so unique. But also, I would say this is the piece that's really popped in 2020. Like the ESG, the doing less evil stuff, there was marginal outperformance, like strong correlation, and then a little bit of outperformance there. But it's in the thematic piece where ICLN, global clean energy doubled, TAN, which is a solar ETF, doubled, really anything with Tesla in it at a significant weighting performed very well in 2020. So, this really is, I think accounts for a lot of the buzz and the sort of pop in 2020. But to me, it's so completely different from the sort of doing less evil, the more sort of ESG approach. And I'll be clear that a lot of these thematic funds actually don't incorporate ESG data. So, you have to be really careful here with, sort of the language and how we're doing that. And then the piece that I get the most excited about, which is on the doing more good side, which might not be as relevant to this conversation, but is this notion of impact investing, where these are going to be direct investments in things like community bonds or green bonds or microfinance, or, these are not publicly traded for the most part. There isn't an ETF that's going to track these things. But, for example, I made an investment in a community bond here in Toronto to a nonprofit that, they've got a space that helps youth who are experiencing homelessness here in Toronto. And they're in the process of buying their building to be able to own the space, to have that consistency, and then such that they don't have to pay a mortgage in the future. So this is building financial resilience within a nonprofit here in Toronto called Sketch that really, I'm not doing that for the risk-adjusted returns. I'm earning 3% interest, but that's not really why I'm doing it. Here I'm making sort of a direct investment in a nonprofit. This would be sort of what I would call like the, crunchy granola style of sustainable investing, where, everything else is the secondary market. We can talk about impact, but it's more invisible hand type things. Whereas impact investing is really going to be, the direct, positive, measurable impact. So, that kind of, I think, gives you an idea of that broad spectrum. That my job is to help clients understand sort of how this would fit into a portfolio, understand the risk return trade-offs. If you want some of them doing more good stuff, that's fine. There are more trade-offs, not necessarily on the performance side, certainly wasn't in 2020, but certainly when it comes to the risk side, when it comes to liquidity and tax optimization, all those fun things, it does get a little bit more complex.
I think a key thing that you're mentioning there is just the breadth of things that we put under this umbrella. Inevitably, it's going to be very personal. Inevitably, you're not going to find one product that's good for everybody who claims they want to be interested in ESG. And I think it's also really important to point out, we're talking about radically different audiences for some of these products as well. So a lot of the growth, for instance, in the US ETF market came because a bunch of either sovereign or pension funds or things like that from Europe decided they wanted US market liquidity. And so they moved billions of dollars into bespoke products made here based on MSCI indexes. That version of ESG is what I would call sort of the most watered down version, right? The idea is to minimize tracking error. There's some basic guidelines around things like fossil fuels, controversial weapons, et cetera. There's some classic sort of exclusionary screening stuff going on. But at the end of the day, they're still designed to give you market or market-like beta and also charge something like a beta fee, right? They're not charging 1%, they're charging fractions of that. But that's just a very narrow corner of what we mean by ESG. And a lot of the more interesting and exciting stuff, as Tim is saying, gets harder and harder to put in a packaged product, right? It's really tough to put microloans and community lending into an ETF. Really just doesn't work.
And so how do you suggest, or how do you help the clients and the allocators endure the tracking error? So today we're talking about the positive tracking error that came from some of the environmental side. Of course, when you get the positive, there's the chance for the negative and for the envy that would come with any kind of market cap weighting against whatever benchmark the individual investor has. Any words of advice on how you help the end client understand that before they start, stick with it as
that
they
seems
go
like a
along?
Tim question. I mean, that's what you get paid for, right?
I'm happy to.
Yeah. There's so much overlap,
and,
right?
To me, and so the biggest part of it is managing expectations. Honestly, we can talk about tracking errors for the average investor. They're not looking at that metric, right? So what they're really looking at is understanding sort of the risk return, the volatility of the fund. And certainly whenever I see a year like this year with significant outperformance, my number one job is managing expectations, saying don't expect this every year, right? And in fact, communicating that actually now it means when we're investing money, we're doing it at more expensive prices. That, so much of this, I think, is about behavioral piece, the psychological piece. And then it really is about managing expectations. Now, there is a wide spectrum of investors in this space. And, as Dave pointed out, I think a lot of the sort of the whales in the market, the big institutions, are doing what I would call a small step in the right direction.
Better than
and
nothing.
Hey, I will applaud that, 2 thumbs up. That's great. Is it going to go far enough for me? Definitely not. Right. But, there versus my clients that want sort of what I would call like a squeaky clean approach. Right. Which is obviously going to have much, much more tracking. So to me, it's really about communicating these trade-offs. And the language that I use, or sort of how I approach this, is I think of a spectrum from what I would call finance first investors, where really what they care about is market rates of return, right? Is adherence to those benchmark, is that, a beta profile, right? And fees, usually very fee conscious as well. And to them, the ESG or the sustainability piece is kind of icing on the cake. Like, hey, if I can get the same thing without investing in, the worst of the worst, hey, okay, great. That's fantastic. I'll do it. But I'm not really willing to sacrifice anything, either on the risk or return, or even in terms of tracking. All the way through to like, I have like clients that are like anarchists, right? That are just like legit, like think that capitalism is so broken that, we would be better off if it collapses. And the way I talk to them about this is to say, well, really what we're doing here is hedging against capitalism enduring. That the last thing an anarchist wants to be is like have to retire into a state-run facility where they're entirely dependent on the system that they hate. So this is, so for them, they are more than willing to accept lower financial returns, although they haven't had to. My squeaky clean portfolios have done incredible this year, but they would accept that. They'll certainly willing to accept tracking.
Tim, how do you find when you're really working with clients, because it sounds like you have a very broad spectrum, but sort of you self-selected and said you're not going after the super high net worth folks with the multi-million-dollar family office stuff. You're focused on, retail investors who have enough money to invest. Do you find that the folks that are most ESG centric are also most local? Because that's something I've always sort of wondered about when you get to the face of the coal mine there. Do things like community development projects start coming to the forefront and all this ETF stuff is for the birds?
Well, I mean, I think it's a balance and everyone's going to be different. And, certainly I have had clients that are super, like they really just want to do those sort of so-called impact investments, right? The sort of crunchy granola stuff. But, the supply of product isn't really there yet. We can't really diversify. And there's some major tax implications. Those things are a pain in the butt to hold inside of a registered account. So, there are major sacrifices. So part of my job as a financial planner is I think to take those people and hear them and listen to them and understand them and kind of, nudge them towards the center a little bit, saying like, hey, is there a way we can do this where you can at least like hold your nose and, let me try to find something that you can at least tolerate. You might not love it, but you can tolerate that'll give you an approximation of market rate returns to then give us, I would say, use that as the anchor of the portfolio to then be able to carve out obviously a much larger piece for this impact side of it. Obviously it gets a lot more complicated there. Right. So, it takes more time. My fees sort of go up. So, it's really going to be each person. It's really about finding where they are. What I find is the vast majority of the market understands the need for compound returns and understands the need for capital appreciation in saving for retirement. They just don't want to do it in things that, by investing in things that are contrary to how they live their lives. If you're working for an environmental nonprofit or a social justice organization, or, if you've dedicated your life to helping people or helping the planet and studying this stuff, the last thing you want to be doing is really investing in things that go contrary to that. So, what I would say is that there's a really wide spectrum. I'm super excited, at the super high net worth, like once you go up, some of the innovations like direct indexing, like I'm so excited for direct indexing. Like, my goodness, what I could do with that through an ESG lens, it's just going to be super, super awesome. That said, I think what most people are looking for more than anything is simple and easy and efficient. This is where ETFs and the DIY and, there are tools such that we can, automatically rebalance. And, that's why I really sort of nudge people in that direction. Understanding that, you do know how to talk to the sort of the people really very far on the impact first side of the equation, and really what it comes down to is managing expectations and being transparent that like, it's not perfect. and there's stuff in here you don't love, but what we're gonna do the best we can given the products that are available today. And what's so exciting for me is, to Dave's point, that the momentum from everyone else that's coming on board and everything here is that the ecosystem is so much more developed than it was even a year ago, let alone a decade ago when I started in this space. That, that now there are so many products across that spectrum that really, for me now, the challenge is education, understanding these different options and sort of the different profiles, and then really just getting people, I think, through the sort of analysis paralysis that, for a lot of investors, they don't want to sort through this and they don't want this. So, working with an advisor who can identify sort of where they are on that spectrum between impact first and sort of finance first, and then showing them like a few different approaches and building a portfolio that incorporates both the doing less evil and the doing more good. And then really having a conversation, because you're never going to get it spot on, and really people have these funny little psychological deal breakers where everyone has like this one company that they're just like, no, I can't do it, and I can't predict that every time. So, having the transparency, showing people what's inside, helping them understand, letting them know that it's, that for any one product, it's not going to go far enough for some people. It's going to go too far for other people. And then really helping people kind of land at a place where they are comfortable with those trade-offs.
So, Dave, for you, dealing with sort of a vast array of advisors, what are you seeing as the sort of the top hot points, things that they're interested in, and then also what areas do you think that they need more education or more insight on, and maybe comment on those as well?
That's a broad question. So, there is definitely a class of advisor in the U.S. who is seeing ESG as a huge opportunity for their practices. And those are the folks who show up to webinars when we run them. Those are the folks who ask really interesting questions and read all our ESG articles. And for those folks, what they're, to Tim's point about direct or custom indexing, as maybe we're now calling it, they're starting to realize that for their highest net worth clients, package products just aren't going to cut it. And so I suspect over the next year or two, we're going to see a raft of technology solutions that really solve this problem. The first one in the US that's really gotten some traction recently is from O'Shaughnessy Asset Management. It's called Canvas. There have been a couple articles about that recently. The key thing that you get when you move from a packaged product to something that's a little more customized is that exclusion problem getting solved. So many high net worth investors are high net worth because they made a really good career choice at some point, right? They're sitting on a pile of Google stock, or they're a senior manager at General Electric. It doesn't matter. They have a huge economic exposure to either a single industry or a single company. Custom indexing lets you just cut that right out or manage it down in an interesting way. And along with that, you get the opportunity usually to make some ESG calls as well. So ESG and a custom indexing model is often actually coming in second. And the first thing that you're getting is that I have a specific single stock problem. So at the high end of the market, that's what we're hearing a lot of advisors talk about. How do I customize this solution for something that's going to be really valuable? I would say the second thing is actually about voting. Like there's a lot of discussion in the US about shareholder voting, shareholder advocacy, and BlackRock has made a huge deal out of this. We saw State Street sort of follow suit on this, and how companies vote their shares has become a really big issue. And it's sort of an interesting piece of marketing if you think about it, to be cynical about it, right? If you're BlackRock and you're sitting here on trillions of dollars in assets, you don't really have the option to say, but we're not going to own Chevron, because you've got clients that want Chevron. You run energy sector ETFs, right? Of course, you're going to own a lot of Chevron at the end of the day when you're BlackRock. So spinning this to be about how you vote, I think is a really interesting conversation advisors can have with their clients, where if they are feeling like, yeah, I kind of just, like, as you called them, they're really finance first investors. I think is that what you called it? Finance first? I love that idea that, I'm not willing to take a lot of tracking error. I'm not willing to, make any big bets here. I kind of want market returns. Oh, well, maybe you should make sure that you're getting your beta exposure from somebody who's going to vote to change Chevron, to change Volkswagen, to change sort of these worst offenders, Facebook, whoever it is. I think there's actually some real weight to that. Now, the flip side of that is regulators are a little concerned about how much voting power some of these firms have. And I don't think that's a conversation we're going to ever finish. But I think that's a real issue. So like, and then after that.
But expand on that, Dave. Expand on that, Dave, because I don't know that everyone is quite aware of this issue of these large voting blocks that Vanguard and BlackRock hold. So I think for the audience, just expand on that.
It is a truth that if you look at the combined holdings of State Street, Vanguard, and BlackRock, the big three as we call them, depending on which part of the market you're in, they own something between 15 and 35% of the voting shares of every company in the world. Now, obviously, more or less, depending on which indexes, et cetera, it's more concentrated in large cap US for obvious reasons, less concentrated in, say, small cap cannabis stocks in Canada. But overall, it's still very, very large voting blocks. And there are pros and cons to that. And regulators and more like hand wringers at the Financial Times and things like that sort of get a little concerned that somehow this is anti-competitive, that there's going to be collusion. There have been some studies around things like airline ticket pricing and whether or not companies that are in the same index prices competitively, et cetera, et cetera. Most of that is false. It's just sort of garbage. But the concern still exists. Yeah. The flip side of that is these people do have large amounts of power in their voting blocks. And so when somebody like, say, a State Street starts voting against slates of boards of directors because they don't have enough women on them, it actually matters. Like slates get voted down because in many cases, things like mid caps, that might be 20% of the voted shares on a proxy. So it is a real issue. And even if you're not an ESG investor and you wouldn't call yourself that, there is a difference between whether you choose to get your, say, S&P exposure at State Street or you choose to get it from Schwab.
And are there insights that the investors can garner? Like, can they find insights on some of the funds that may take the approach of using their votes in this way in order to affect their ESG
not as much as you like, right? The transparency is still not quite there. Now, technically, yes. If you are super interested in how BlackRock voted the Tesla proxy on employee compensation, or how BlackRock, that you can go find that out. It's not that it's hidden. But there's not like a really nice, polished, clean report you can hand to your clients every quarter saying, here's how we voted on 5 hot button issues. I'd love that.
Yeah. The best I've seen in Canada is BMO. I walked through some of their proxy voting. I feel like they're sort of the standard for that now, and I would just love to see that.
And really in Europe, it's pretty common, right? So if you go to some place like BNP Paribas, you can get like a 20-page document that says how they will vote on employee compensation or carbon footprint issues, and that's really helpful.
And so we've talked about a couple of tools that advisors and allocators can use. I think you mentioned MSCI, Morningstar are a couple of areas. I'm pretty sure your ETF database probably offers.
We have some of it, but even then, ESG access to data is still a big issue. And as much as I'd love to say, come to my website, we'll give you everything for free, ain't the truth, right? MSCI and Sustainalytics, now Morningstar, charge a lot of money for this, and they should, right? If you look, just say, I'm most familiar with the MSCI data set. I've dug deep down into the well on that. And you're getting like tens of thousands of companies, 300 or 400 data points. So if you're going to subscribe to MSCI, you're going to need to pay for that. You're not just going to be able to get that for free. And that's what powers most of the funds out there are these big data sets, which frankly didn't even exist 10 years ago. So this is really exciting new stuff.
So how does the advisor or the individual investor empower themselves? Like, can you give the listeners some tips on, Tim, you talked about, I use this database, I use that one, but there's some nuance. And so let's dig in there and provide some tips for everybody.
Sure. So, there are high-level data points available for free, and if you want, I can sort of provide the links to your audience. If you do want to put them in the show notes. Sure. But MSCI does offer the high-level company ESG scores, as well as the high-level ETF scores. For free, which is fantastic. It's just specific links. You got to know where to click, and then you can just look it up by ticker symbol. Sustainalytics does offer the individual company scores, again, high level, on their own website, as well as through Yahoo Finance. That if you look up a company on Yahoo Finance, there's a little sustainability tab now. And that Morningstar does provide high level ESG risk ratings, as well as carbon footprint analysis for mutual funds and ETFs, that it's basically, Morningstar.ca. I tend to do the Canadian one. And then you look up the ETF and there's, I believe it's the analysis tab, might be the portfolio tab. They've been shifting it between the two. So those are kind of like the free resources. From there, really for advisors, I imagine most of them subscribe to some form of research. And often you can get ESG data available through, whether it's Thomson Reuters, whether it's Bloomberg Terminal, they've got relationships. There's a good chance they already have access to this. To Dave's point, it just gets complicated quickly, that really it can be sort of, drinking water out of a fire hose when it comes to these ESG data points. So it's going to take some time to get comfortable with it and to understand, sort of how it works, how to look up which ones are legit. This was a lot of work I did in my thesis, 12 years ago, was focusing what are the most financially material ESG risks. So we looked at these, 300 plus different ESG indicators. And really what we found is that it was sector by sector, that each sector has their very different ones. It was curious. Our research found that the one most strongly linked to outperformance across the board actually is gender diversity on the board of directors. Now, correlation does not always equal causation. I get that. But at the same time, it's been that way for like over a decade now. I think the data is pretty compelling that gender diverse boards of directors do make better decisions. So it's a bit of an interesting thing. So you got to be careful not to get lost in the weeds. There's a lot of sort of meat on the bones when it comes to this ESG data. What I would say is that really for advisors, they need to understand which issues really matter to clients. And the language that I use is that sort of the best teachers in the world, what they do is they show you the sort of tiniest sliver of truth at exactly the right moment. So it's not about overwhelming someone and then talking, well, there's this ESG and then this indicator, but not on this indicator and this and that. The voting record for this fund, like it gets complicated, it gets overwhelming, it gets, and you just lose people right away. So to me, it's really, about if you're going to be making these decisions yourself, do a little bit of homework, understand the different research providers, find the sort of high level scores that you can trust. From there, sector by sector, get a feel for, a handful of specific issues that you really think matter to that sector. And then on a client by client basis, really get comfortable playing in the mud and in these gray areas of ethics and values. This is where my philosopher training, really comes to play, that I'm happy going in there and let's talk about ethics and morals and especially with this intergenerational
there, right? Because
transfer.
One of the counters to ESG, which I personally am a fairly committed ESG investor myself, but one of the counters to ESG investing as a theme is, wouldn't it be better to maximize your profits and then take the excess profits that you got from bad behavior, gun manufacturers, whatever it is that you didn't like, and then going and doing impact investing with that profit? And we can have an argument about whether that's correct or incorrect, but you certainly can't say it's not an argument. Yes, that is an argument people can have. And so it does get blisteringly complex. I think one thing advisors can do is, they're going to be more successful the more genuine they are. So asking what they think is relevant is probably a good start. And I know some very skeptical advisors here in the US who are not big buyers of ESG personally, but they're willing to say, hey, you know what? There's a risk management component here, particularly around governance, that I'm all in on. And they learn that. They learn it cold. They learn examples. They learn which funds are really using governance as a risk management thing that's keeping them out of the next Volkswagen scandal or the next, opioid settlement scandal, et cetera. And ESG factors have been really good at just managing those sort of outsized governance risks. And some advisors are just saying, that's my approach to ESG. I'm all over risk management. And if what you're worried about is, diversity on boards, whatever. I'm not paying that much attention to that. But that can be okay if they know their client base.
Yeah,
certainly. So now, do you guys go ahead, Tim?
Yeah,
or Pierre. Sorry,
I was just going to say that I think a lot of advisors really want to know, the burning question is what's in it for me or what's in it for my clients. And, I'm curious to know how much of what's happening in the ESG movement is the tail wagging the dog, and how much of it is actually investors saying, I want this.
So from our experience on the survey side of things, this is almost exclusively being driven by clients. There are a few advisors that are building ESG practices and trying to be known for that. But the overwhelming majority of the surveys you see, particularly just like surveys of high net worth individuals, say under 50, sort of in that, like I said, the young Gen X, the older millennial group, many of them are saying it is their number one priority in investing. And that's a huge shift from boomers where it was like 20, 30% said they were even considering ESG. So there has been this phase shift. I'll caveat that by saying that when somebody says that they want something non-economic out of investing, I never believe them, but they're saying it on a survey. So there's some truth to it.
Well, and there's flows,
and
there's flows to back it up too. So we are seeing flows. The adoption might be chasing performance. It may not. There is that iterative loop that comes with, once you start to put ESG into play and flows start to follow it, the cost of capital for those firms that are complying and trying and getting better it gets reduced, which gives them an advantage. So bad actors have definitionally a bit of a disadvantage, which then makes them want to modify their behaviors and their approaches. So I think it's like a flywheel. It started 10 years ago, and it's it's an overnight success this year. What are your thoughts, gentlemen, on so we're going to put this in action. We've talked about maybe individual stocks we could look at, but when you're looking at allocating to managers, should they go passive? Should they go active? What are your thoughts there?
I guess I'll go first. So, active
Dave.
has traditionally been what you had to do if you wanted to get into the space in the U.S. Folks like Calvert, there are a number of, traditional mutual fund managers in the U.S. that have built quite large practices around their ESG analysis. I think it's becoming less important because the data's gotten so much better. 10 years ago, I would have said, if you really are hardcore ESG, you kind of have to go find an active manager. And if you're not an active management guy, that's what you're holding your nose on, right? Because that's how you're going to get that access. Now, I think the data's good enough that, unless you're really going more into the impact zone where you really do need somebody chasing down those less liquid opportunities, I think you can do a lot of good and do a lot of change to your portfolio using pretty cheap beta solutions. So I don't think you have to go active. I think active is where you end up if you're really serious about the impact side. Tim?
Yeah, I think, I've always felt really constrained by the options that were on the table. So, to me, this has been the hardest thing of like, it would be great to have, and for a long time for me, it was about fees that, for so long, you just had to pay such a premium for ESG. And that's just no longer the case. The fees are lowest on the passive side. But to be clear, when it comes to ESG, there's still an active side to the passive funds, that there is a methodology, that there are screening procedures in place. Right. So to me, it's really much more about alignment and fit with the client's values. That if we can find a passive low-cost solution that fits the bill and that there's nothing in there that makes them want to puke, then that does, I tend to sort of, have a preference in that direction. We've also started to see a number of funds that use sort of a multi-factor approach, right? Which is interesting because again, it's still passive. It's still, but again, with this specific algorithm. So if you're worried about the growth piece, then you might consider having, something that's going to have a little bit more of a value tilt in there for a little more diversification or just like a different style of investing. I would agree with Dave when it comes to the doing more good side of the equation. And even when it comes to the thematic piece, what I found is that a lot of these sort of actively managed, even the mutual funds with, MERs of like 2.25%, 2.5%, which to me is just highway robbery. A lot of them have earned their fees, that really it is shifting so fast that to be ahead of the trends. What we saw in 2020 was, growth in a lot of what I'm going to call the sexy sectors. So, electric cars popped, solar panels popped. We saw some growth in some of the more, things like energy efficiency or like these renewable energy utilities. But they're always, it was much more subdued compared to, something like the electric vehicle theme. So to have someone that's following that's understanding that can anticipate those market dynamics, I think there is the opportunity for active managers to add value in this thematic space. But it's really, it was really just about 2 months ago, I think early October, we had our first active ETF on the doing more good side, AGF, which has, I think, the oldest sustainability mutual fund in Canada, started in 1991. Right? It's absurd. It's been around it's about to have its 30th birthday. And they just turned that into an ETF, AGSG. Is the ticker on that one. So this was really the first time where I was able to actually get access to an active sort of sustainability themed ETF in Canadian dollars. With a fee, it's still, I think, 65 basis points, and then probably plus HST that we'll get. So, let's call it 72, 73 basis points, but obviously so much cheaper than even the F-Series mutual fund that was offered before. So, to me, it's one of these things where, again, just like in the normal space, investors are going to have different preferences. I think, to me, I do tend to have a bias towards the low fee that, if in doubt, go with the lowest fee option.
You'll have a friend in Dave for sure.
Control what you can control,
Yeah, but like, well, this is it. And then, but then beyond that, understanding that really there are so many different styles, there are so many different things. In my experience, it really is the values fit that is kind of most important and the toughest thing to nail. And then, once we have that, if there are multiple options that fit the bill, fantastic, more choices, more voices, I'm going to be happier. But, right now we are still limited. Like it really is, I'm still like scouring the ETF launches, sort of month to month being like, please, can we get a green energy ETF in Canada? I think there are 2 of them that have prospectuses now. But, for the longest time to invest in an ETF with some of them like Canadian companies like Brookfield Renewable, Interjex, Boralex, these great utilities, renewable energy utilities that are Canadian companies, to get exposure to them inside an ETF, I had to convert things into US dollars. And buy US dollar ETFs. So, it really is, I think that the ecosystem is evolving and emerging. And that, I would say let's give it time to be sort of a fully functioning ETF ecosystem before we make any definitive decisions on active.
How do you guys recommend that? Just one add-on question, because Tim touched on a point where we're expressing these values and we're scouring the universe. Now, how do we balance one of the granddaddy of them all investment concepts of diversification, right? The idea that, in an inflationary growth environment, things like oil and gas, commodities, they're going to do really well. Since the election, copper stocks are outperforming the NASDAQ. Yep. So you've got oil and gas stocks that are coming along. So, do you see any structural holes? Well, I certainly do when I look at ESG, and you just think about the whole sort of inflationary growth trade, which is largely emerging markets and commodity based, is where the structural returns come from. So how do you balance that off? Do you just tell the client tough luck? Do you try and find replacements and do a better job? Please,
there
how do we balance
options,
that?
right? And so like emerging markets is a classic case, right? I know a lot of advisors who are currently looking at the global economy, and their global macro call is, look, developed, particularly North American developed, not necessarily where we want to be. We're not necessarily handling the crisis well. I'll speak for the US. But you look at what's going on in Asia and some other emerging markets, and there seem to be these real pockets of opportunity. So then that becomes the question, well, but if I'm a values-based investor, how do I actually put that together? And I think you have to decide where you're drawing the line. So like in emerging markets, right, there's like one option I think is great is FRDM here in the US, which is the Alpha Architect Life and Liberty Freedom 100. Boy, I hope I got that right. Run by Perth Toll. And, that's taking the approach of let's just skip out on countries that we don't want to have anything to do with because, their commitment to human freedom is so bad that the rest of it doesn't matter. So you end up skipping out on China, for instance, and some other countries, and you sort of reweight the emerging markets into a different basket. the end result is you get emerging markets like performance, but you get to avoid some of the worst offenders, if you will, from a values perspective. Now, does that mean that you're also getting rid of every natural resources company inside those markets? Probably not, because at that point, you're going to end up with a list of 45 stocks that's completely undiversified, that's got all sorts of exogenous exposures you weren't planning on. So I do think that there is a balance there, and you sort of have to pick your battles.
Yeah, I wanted to come back. I know so far we've been talking about, opportunities and returns, but I wanted to come back to something that you said earlier, Dave, which was with regards to, for example, advisors who haven't really jumped on board ESG for ESG's sake, and that was the risk management angle, in particular governance. And what are some of can you elaborate more on that in terms of what's in it for investors, advisors listening to this, as to how ESG improves on one side governance and reduces risk, but also in terms of how, and then sort of secondary to that, also how ESG is becoming an important factor in capital markets and, for example, cost of capital.
Sure. So fundamentally, this is just about figuring out whether or not a data point is serially correlated, right? Because if it's not, we don't care about it, right? We want the data we look at to have some impact. So therefore, we hope that the past looks something like the future. It turns out one of the strongest signals in the sort of 400 or 500 data points we collect around ESG are things around core good behavior as a corporate citizen. Things like, are you a habitual regulatory offender who is paying fines year after year because you're not willing to play by the rules? Have you run afoul of anti-bribery, issues? Do you have any of your, senior staff under constant indictment? Like, these seem like pretty obvious things, but it turns out they're a little bit difficult to measure. And until really the last 4 or 5 years, you couldn't say that you had a comprehensive data set on global large cap to be able to say these 45 companies are jerks, so we shouldn't be owning them. It turns out not owning those 45 companies that are jerks really makes a difference in terms of portfolios, because you avoid lawsuits, you avoid government shutdowns, particularly in Europe. European companies that run afoul of core governance stuff tend to get crushed. The markets don't like them. They get thrown out of European portfolios, partially because Europe is much deeper in their adoption of ESG than we are in the US. So there's a bit of a self-reinforcing, wheel here. I mean, Mike, you called it a flywheel. I think around governance, that's particularly true. Bad actors around governance issues tend to get crushed, particularly in Europe.
And then now, in terms of the governance. And we're seeing things like where boards are adding women in order to sort of be included, and not only to have inclusion of women in their boards, but to be included in ratings. And so how does that's where I guess where I was going earlier with the tail wagging the dog is how much of the ESG movement is about doing good versus sounding good.
Yep.
Yeah. I can speak to that. Yeah. So okay. So a couple different things there. I think that you've identified, and I don't know what to call it on the diversity side of it, diversity washing, but certainly on the green side with greenwashing, and really this is the fundamental question. Is how much of it is sort of greenwashing versus how much of it is financially material. Now, really, here's where I come from, because I think a lot of these conversations, certainly in the industry, judging from your audience, the worldview that people are going to come with is that, we have the economy, we have the stock market. The stock market is perfectly efficient. Everything's working great. We've made all this money. Everything's fantastic. And now, ESG, you're coming in, you're trying to muck it up, you're trying to change things. I have to, relearn all these things that, I've over the past 30 years have become really standard. Whereas, I'm coming in and my clients are coming in from a very different perspective, which is that capitalism is broken.
Yeah.
That right now in the recovery, we're seeing this K-shaped economic recovery where some people are so much better off than they were at the start of the pandemic, Whereas, lineups at food banks are longer than they have ever been in the wealthiest countries. Specifically in the US is where this is worst. Amazon, with one of the most profitable companies, look at the wealth of Jeff Bezos at the top, whereas the injury rates and the sickness rates of factory workers, and we're now seeing data showing up that when Amazon puts a factory in a town, it depresses all of the wages within that industry, within that town, that all factory workers end up with suppressed rates. And then climate change as a major systemic issue that, the Bank of Canada has come out with a report saying that if we don't take climate change seriously, that up to 45% of Canada's GDP is at risk in the year 2100. 45% of our GDP. And so, really, I'm coming at it from a place where capitalism in the stock market right now is not working for the vast majority of people in our society. It is certainly not working for the planet itself. If we continue on this path where, really it is about, strictly finance first, and we're going to completely ignore social and environmental issues, this can't continue. So I think the reason why, to Dave's point, that all of these, I think the biggest movers, the biggest whales are all these institutions and all these pension funds, these institutional advisors, that they have a mandate. They are what we call universal investors, where their biggest worry is the global economy as a system. And they are in this for the long term, for, in perpetuity. So, really, it's to me, it's these are the changes that are absolutely necessary. If we want to talk about having a fully functional economy, over the next 50, 100 years, that we need to incorporate environmental, social, and governance, really across the board, that this is going to impact everything. And this is the macro change, the shift that we're seeing now. Because, in the crash of 2007 or 2008, 2009, in the comeback, all this stuff got thrown on the back burner. Right? Nobody cared about these issues at all. Whereas to Dave's point, it started the end of last year and the first 2 months of this year. Remember those fires in Australia and how climate change was on top of everyone's mind. And then for the last year, we've seen a systemic risk that, without a healthy population, there is no economy, right? That now all of a sudden we are seeing governments, we are seeing central banks, stepping in and saying, no, what is crucial to our economy is social, environmental governance broadly. Now, obviously, as that's affecting the stock market, the immediate impact right now we're seeing is with carbon pricing. This is, I would say, the first externality that is immediately being internalized here in Canada. We're going to have $170 per ton of CO2 in 2030. I expect in the US, I'm going to hold my breath until January 20th, the inauguration, right? We're not going through that. But, assuming it looks likely that they're going to be moving in this direction, that we are witnessing a dramatic repricing of assets in the stock market, accounting for these previously externalized, ignored issues. So to me, it's as an investor, as an allocator, what's at stake here, Pierre? Well, really, it's about your portfolio and protecting that. For an advisor, this is about your practice. Because if you, I can't tell you how many clients have come to me because they went to their advisor and their advisor laughed at them, mocked them, made them feel horrible by bringing these things up. And then to Dave's point, all the surveys are showing that, it's at more than half of investors when asked want these types of things. When you say that you don't have to sacrifice returns, that the returns are comparable, that number jumps up to high 70s, right? Especially among the lower, right? And then, but when I look at the question of how many people are actually doing it, that number is very low,
access
even with the surge that we've seen.
Many investors are limited in terms of where they can access. In the U.S., most retail investors, their only real investments are in their retirement plans, not in some taxable account that they can trade through a brokerage. And if you're in a retirement plan, at least in the US, you've got very limited choices. Now, many retirement plans have included mutual funds that have ESG components to them for years, but a lot of them haven't. So I think that access issue remains a huge one.
Yeah, I was just going to say, I just wanted to add that, in terms, the term sustainable or sustainability is really, I'm getting the feeling that it's really widely misunderstood in terms of what that means. And that there's really actually what I see is that there's actually a line in the sand that's drawn with that word. And on one side is what's unsustainable behavior, unsustainable business practice, unsustainable energy production, unsustainable whatever. And on the other side is what is sustainable in the long term. And so I'm really excited about this conversation, by the way. But so I've been really listening listening to it, and so that I think is at the center of it is the term itself, and understanding what sustainable means and how it's used, how the term is used, and it's not just about endlessly available natural gas or endlessly available electrical power from solar. It's really about behavior more than anything else, and what's sustainable and what's unsustainable behavior. So thank you. I just wanted to just add to that conversation, because I think.
And we all want the same thing, right? Like, we want a sustainable economic system, right? We all want sustainable returns on our investments. Like, that's at the end of the day what we want. In my mind, it's just been unfortunate that sort of the way the economy was set up, however long ago, like, it really didn't consider a lot of these social and environmental issues. And that's what really is changing now, that we actually have more data now, such that we can make more efficient decisions. And, and Pierre, to your point, about sort of commodities and that, I think fossil fuels is a huge problem for a lot of people right now. As much as the environmental side, I think the governance side, to Dave's point, that, the amount of money and the lobbying that's been spent sort of delaying action and misinforming, like, there are a lot of parallels between tobacco and there are lawsuits coming out now that are, attempting to expose that. So that's why a lot of people, it's a real thumbs down. But on the material side, I mean, there is such a need for rare earth metals and minerals. And like, in a clean energy transition, there is going to be a huge need for a lot of raw goods and commodities. And, I just feel that Canada, we're in such a position to be able to capitalize on it, where we have access to this and we can do it in a clean way. And if these companies are following ESG best standards and looking after people and looking after the planet and really doing that, there's so much opportunity there. Unfortunately, I think that for a lot of people in the industry, it has become a political issue, right? And this is an issue where they often find themselves, I think, on the wrong side of science, especially when it comes to climate change. And that, it invokes a lot of feelings. And I would argue here in Canada that there remains a negative bias against ESG. A lot of people dismiss it as sort of BS and like, it's for the hippies and, fairy dust and unicorn farts and, that type of thing. And I think that, really what I'm seeing here is that, it's too bad, because I think if people, this is the way forward as far as I'm concerned. And, it's been so nice for me to have this year, 2020, really kind of have the vindication that a lot of things that I've been talking about for, over a decade now, are really starting to come not only into public consciousness on the psychological side, but into market dynamic and pricing. Like, prices have shifted.
Yeah, sorry, Mike. I just wanted to add that I read something interesting this week, which was from earlier this year from Professor Damo Darren from NYU. And it was just a point that he made about that it was the 50th anniversary. I'm just going to read it. As the 50th anniversary of one of the most influential opinion pieces in media history, where Milton Friedman argued that the focus of a company should be profitability, not social good. There have been many retrospectives published in the last week with the primary intent of showing how far the business world has moved away from Friedman's views. And I think, it speaks to, I guess I would say that Milton Friedman's work is one of the reasons why so many people feel that, this is a lot of fluff.
Yeah, I think that what we've learned in 50 years is that society and economics are much more tightly tied than we used to think they were. And that largely has to do with the dissolution of social safety nets in most of the developed world, right? The reality is we can no longer say that this company can be as profitable as it wants to be and have no impact on society. And society, when they get annoyed at that, will have no impact on the value of that company. What we're seeing is the inversion of that. Society, i.e. those of us with money to invest, are starting to vote with our wallets enough that it's starting to impact these companies. Otherwise, we wouldn't have greenwashing scandals. We wouldn't be talking about whether or not people are buying carbon offsets and already protected forests and things like that. The reason we're having those conversations is because it does matter, and society has pushed back.
Have you seen of the individuals who are ESG investors, do you see them taking up that same behavior in their own personal lives? What I find is interesting is the cognitive dissonance that is in some of these environments at times. You mentioned one, batteries and rare earths and where they come from and how they're mined are potential atrocities and how you want to look at it, the disposal of the battery, all of those types of things don't clearly put a battery operated car that much further ahead. What would be far more beneficial is if people owned one car. Our family has one car, not three cars, and that's a choice. It is a battery operated car, but at the same time, I do think that there is a a very small island. Yes, it's true. Come on, don't pull the curtain back right away. It's the big reveal for later.
Your point is very well taken. Is that these are decisions that are not made in a vacuum, right? And I'm the same way, right? I have one, ICE car, and I have a Tesla, and we went through that math. It's like, okay, you have to drive a Tesla for 100,000 miles for it to actually sort of earn back all of its carbon payments. People have measurements on that, but it's a real issue, and I think it's worth bringing up, Mike.
Yeah, and I think that, again, to me, it's something that I think the industry needs to get better at, is having thematic funds that incorporate the ESG space, right? Because, a company like Tesla, great example, ESG darling in a number of portfolios, their social score is atrocious, the way they treat employees, right? They're very, very high risk, very poor labor force management there. So, it's not going to be perfect. And I think that one thing so in terms of my clients and, me in my life, certainly just about all of my clients have incorporated this decision-making throughout their life in terms of their purchasing, in terms of their voting, in terms of their volunteer time or donations. And it's often investing is like the last piece of that puzzle because it's been the hardest, right? So I've met a lot of clients that have come to me saying, Tim, I've tried to divest from fossil fuels for, 30 years. And you're the first person that now, is actually able to help me do that in an efficient manner. So, I think for a lot of people, this is the sort of one of the last pieces. But the other piece is that inherently, we're all hypocrites. In the environmental space, I eat food that has a carbon footprint. I'm broadcasting right now, and I have computers and we do this. There is no such thing as a perfectly sustainable person or anything like that. But that doesn't prevent us from fighting for the changes we want to see in the world. I often joke about people. How many people do I know who hate taxes? Where they'll fight against any form of tax, and it's like, but of course they drive on the roads, and here in Canada they use hospitals, and their kids go to public schools, and they use those services. That we're all hypocrites. Nobody is perfect, and that to me it's just about how can we sort of most closely align things for both ethical reasons. For a lot of people, it is ethics first. To the point Dave said before that, you should just invest and, take the returns and give it, and that's like asking someone who's kosher, you should just, eat the pig and don't worry about it. And then we'll just over here, we'll donate money over there. No, for a lot of people, this is just a hard no. Yeah. They just won't invest otherwise. And then for everyone else, if you are on the finance first, then what you need to recognize is that things are changing right now. And, I would point back to a lot of the evolutions in valuations around branding and how for a long time, markets didn't really value a company's brand, and then Warren Buffett comes along and all of a sudden, the Cokes and the, McDonald's and the brand names all of a sudden now trade at a premium because of that. And that's considered very, very rational. In the same way, we're just gathering more information now about these companies and, really letting people make the decision for themselves. Everyone's going to draw the line somewhere, different along that spectrum. And that's a very, very personal decision. I don't think we should judge people based on where they've decided to draw that line. But at the same time, I think that in my opinion, and really I would say the uphill battle that I've been against for 10, 12 years now is that, so many people in the industry are just very quick to dismiss it based on politics, and instincts or intuition that they think these things are BS or going to underperform. And that now, we have data and we have the information to show that actually, this makes a lot of sense. It's data driven. It's not perfect, but it is getting a lot better. And, as far as I'm concerned, we're in the second inning of this transition.
ESG.
So, there's still a lot of change to happen. There's still a lot of assets, Dave, in terms of the, overall slice of the pie. If this thing does continue, there's a lot of room.
The ESG integration seems to me to be sort of the most parsimonious index-based way that you might, I would like everyone to be more cognizant of the ESG. And so if you're an oil company, I'm going to drive a car. I have gasoline in the car. I would like you to be thoughtful about the decisions you're making, accountable for some of the environmental impact that you're having. And if you do so, then I would certainly, move to own that company and use that company. I've one other thing I want to bounce off of you guys too is what tax should, or how should the developed markets help the emerging markets? How should they help in helping them foster the growth? I mean, carbon and fossil fuels have fostered a massive amount of growth for the developed market, and the Western world wasn't accountable for the environmental damages over time and was able to build an economy based on that. And now we're sort of saying, okay, we're going to deprive some of the emerging markets or have a higher cost for them. How should we think about that? How might we think about assisting with some of that, given the experience that the developed world has had?
Oof, that's a big one. I mean, that starts to get into I
thought we'd get to philosophy.
Go ahead, Dave. The philosopher in me is going.
Economics.
Way to go.
No,
it was the last thing I had to talk about.
I had something I wanted to ask as well.
Go ahead, Pierre. Maybe yours is easier to answer.
They want to pass on that one, so they want to pass on that one.
Well, I can address it. I
got 2 hours.
Let me go a little quick, and then Pierre,
what I got.
Love to hear your question. But let me do 2.5 minutes. Because I get a lot of people that are like, as soon as I bring up climate change as a risk or anything, they're like, well, yeah, but China. Right? Well, Canada's not going to do anywhere, 1.6%. Oh, China. And so to me, there is a responsibility here, and really it comes down to per capita emissions, I think is sort of the fairest way to be able to parse this out. And so, I think there is some responsibility here, understanding that we do need to be sort of first movers when it comes to a lot of these issues. The big issue I have, and this would, I think, hopefully be part of Dave's 2-hour seminar on this, but is that, what really disheartens me is this political shift I've seen towards individualism and protectionism. Whether it's America first, whether it's Canada first, it's like, what's in it for me? What's, my best interest, and, sort of screw everybody else. And, the problem is that when it comes to a lot of these systemic issues, these are global problems. Right. So we can talk about the pandemic and, the sort of lack of global coordination early on and how that hurt us. And certainly we can talk about climate change and how this is a global situation. And if the emerging markets don't, solve it at the same time that we do, then, it really doesn't matter too much. So, I think that unfortunately, what we need more than anything are global solutions. And, in my mind, governing bodies and to have things like, for example, carbon tariffs as part of the WTO agreements, is I think where likely things are going to be headed. The unfortunate part is that right now our politics is so against that it almost seems impossible that we would have, sort of a global taxation and redistribution scheme, something like that. So, I think that's a huge, huge, huge issue. I think that for us as investors, let's sort of clean up our own backyard first. and really, I think push our companies to the absolute highest standards. And then, I think that there does need to be
I'll
a bigger
just say
conversation
that
about this on a
one
global
of the
scale.
advantages that some emerging markets have is that they're not individualistic democracies. And so if we look at China, which I'm not trying to be a bolster of China here, there are all sorts of huge ESG issues with investing in China at all. But if all you cared about was carbon footprint, I actually believe that China will hit its 2030 goals way more than I believe anything in the Paris Accords, because China can actually do it, right? They can simply mandate that they are going to shut down coal plants and turn on wind farms and fix the parts of their electrical grid that won't let them do that now. And they recognize that their economy is going to be a huge exporter of clean tech. They already are a huge exporter of clean tech, and that the faster they accelerate that by putting government spending behind it, the faster that'll happen. I mean, China spends 1% of its GDP on clean energy a year, right? That makes it like one of the largest per capita distributions of money into clean energy research in the world. They're not doing that just because they're good global citizens. There are all sorts of reasons they're not good global citizens. They're doing it because their economy is going to be driven by that for the next 25 years.
Yeah.
Fabulous. You guys crushed that. What's
I got another 2 hours.
I don't understand the problem.
Yeah.
Go ahead,
Dave,
Pierre, you had something?
Yeah. I just going back to what you said earlier about European companies being crushed when they're big offenders, and it struck me that like if you're an investor, just whether you're ESG or not, it just makes it. Is there a time in the future where companies that go on being offenders, that go on not conforming or not fitting into the ESG movement somehow, isn't there a time in the future where those companies' valuations get crushed the same way you said European companies get crushed? I mean, they're just that they're further along in the ESG adoption curve. When we get there, isn't there a time in the future where companies that are repeat offenders on any of those fronts get punished? And as investors, if you own those companies, don't you get punished along with them for ignoring?
I mean, Henry Fernandez,
ESG?
the leader of MSCI, basically made this point a couple of years ago when they were launching ESG 101, which is sort of their ETF website. They were making the point that it's like it really makes no difference whether or not you believe in any of this. The market does, and therefore, if you just stand in the middle of the road because you don't believe it, you're going to get run over, because ESG is going to determine how capital flow moves. Right? And so, I mean, have fun trying to float a super cheap investment grade tobacco bond right now. I mean, it's like those things don't exist, right? I mean, we've got multi-billion-dollar opioid settlements going on. Those companies are not doing particularly well in their secondary offerings to pay off those fines, right? So it is already happening. I think we're a little ways away from, truly ostracizing companies out of the capital markets, but you already see it in the cost of capital.
Yeah, I mean, you're in what I would describe as a disequilibrium from an ESG perspective. And so as investor preferences change around that disequilibrium drives capital from bad actors to good actors. At some point in the future, you will reach a new equilibrium, which will, sort of have a much less of an impact, and you will have better actors and better behavior across the board. But at the moment, it would seem at least that this is still in sort of the, discovery, publication, early adoption, maybe early majority, maybe early adoption to early majority for the vast majority of assets. So there's lots of room before we get to an equilibrium state on it.
It's kind of like deciding not to wear a mask, or deciding that wearing a mask is some kind of bad political statement.
Yeah, I mean, but this is, I'll be honest.
There's a grenade.
Having dealt with specifically on climate change, right? Again, I'll come back to this sort of like anti-science rhetoric. that does tend to be more prevalent, I would say, in conservative circles. Although there's this weird branch of the progressive side that I've seen with people that are very progressive and very much on the sort of holistic side that have now kind of latched on to the anti-science with vaccinations and things like that. But, to me, it really is, are we going to listen to our scientists or not? And we've seen with COVID, the difference between countries and politicians that listen to scientists and those that didn't. And that, I think the same result is going to happen specifically around climate change and income inequality. That, a lot of voices, very, very important, very well-informed voices are either going unheard or actively being silenced within this space. So I think there's a huge danger there. Power structures exist. Privilege, I think, is a really huge conversation in the financial industry and sort of what that means. And I think, to me, it's the hard part is that it's just so awkward for a lot of advisors to open up the door to these issues. They've just really been trained to not want to talk to their clients about politics and about some of these more subjective things. And now with ESG, it's kind of forcing the issue a little bit. So, I think that within the industry, people are going to have to get a little more comfortable, playing in the weeds and in the mud and in the, the value side, and not judging people, if they are being a little hypocritical, and, certainly not trying to talk people out of things, but instead really engaging in an exercise of listening and understanding priorities and values and what's really important. And, I'll say this, that when I do have a tough conversation with a client about this stuff, but they come out of it feeling heard and feeling acknowledged, and that, we've come up with a solution that at least works for them for now, that they're a client for life. Like, the trust that I've built there by going there and having that tough conversation means that, really there's a bond there that, I think of a lot of advisors would really be quite jealous of from a business perspective.
Dave, what about you? What about final thoughts for you, Dave? What do you got? What's the ESG takeaway?
I think that one comment on your sort of thought about what we've learned about COVID and the anti-science. The difference is that you can't shut your borders for climate change, right? We're facing that as a global problem, whether we want to or not. And I think we're starting to become global investors, whether we want to or not. I mean, home bias is slowly edging out. And Canada and the U.S. have some of the worst home biases of any population in the developed world, but we're getting a little bit better at that. But mostly, if you're an advisor and you're approaching this space, this is an opportunity. I mean, as Tim was saying, this is an opportunity to never lose a client again, because if you put somebody in a customized portfolio that represents their values and they understand the trade-offs they've made, that's sticky money, right? That's very sticky money. And it's way stickier than if all you're doing is sitting there trying to find the next hot hand active manager, because you're going to be wrong and then you lose that client. But if you're down 1% or 2% versus a broad benchmark because you made certain values-based calls, those can be positive conversations with the client because you can talk about what you avoided.
Yeah. I think there's some pretty significant research out there on the fact that you're far more likely to stick with an investment if it identifies specifically with your values. If you've made a decision based on values versus performance, you have a much higher level of discipline. So,
yeah, I mean there's that word that comes to mind again: a portfolio that you can sustain, that you can sustain ownership of.
Mm-hmm.
Right?
100%.
Yeah.
That would help you to avoid the big behavioral mistakes as well.
Absolutely.
Yeah. And I think we saw that data, Dave, you might know this, but my understanding is that we're in March, that we did see significant outflows in a lot of the sort of standard funds, but the ESG funds were surprisingly sticky in the lack of outflows. And I think actually, like, every month there were still inflows in March that, a lot of those investors just held,
the
or in fact,
performance
maybe even
measure,
bought a
if you
little bit
struck
more.
your measurement period at the end of that quarter, which unfortunately a lot of, quarters don't mean anything except we all still mark them, right? So a lot of people put out their quarterly reports at the end of March, or they did their, even better, if they did their rebalance at the end of March, they were just gosh darn heroes, right? Because what were you doing then? You were, selling a bunch of bonds and buying a bunch of equity at the bottom. And if you happen to be doing that in anything that even smelled like ESG, you probably crushed a buy and hold strategy. So it was a very good time for advisors who had a story and had clients stick to their knitting.
Agreed.
Yep.
Well, that was pretty awesome conversation, gentlemen.
That was.
Thank
really
you for having
appreciated
us.
your time and your expertise.